Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today is our third and final installment in our three-part series regarding why traders trade options. We talked about in part one how some traders will use options to speculate on stock moves that they anticipate. In part two, we talked about how options can sometimes be used to pursue income. And finally, today we're going to be talking about using options as protection or as risk management, risk reduction techniques on existing positions. I think this is going to be an interesting discussion. As we did in part one and part two, we're going to be going through two example strategies. So a lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see all the familiar names. So welcome to anybody here that might be new. But hello there, Janelle and Jay Frost, Lawrence, Richard, Charles, JDLMI, Eva, Josh. I think I already might have said that. Who else is out there? Scrolling up. Anyway, you know who, Richard, yeah, Kay Boja, everybody else. Jack, thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you do happen to be among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to watch these webcasts. But if you'd like to be here in our live stream audience, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my great friend Kevin Horner is going to be hanging out in chats. He's going to be addressing any questions that I can't get to as they pop up. Kevin and I have been now working together for years. Everybody, I think, here knows Kevin. You know he's great. Thanks for having my back there, Kevin. Kevin and I would also like to issue an invitation to everybody to follow us on social media. That's where you connect with your favorite presenters in between the live streams. So you can find Kevin and me on X. You can find Kevin there at Kevin Horner CS. You can find and follow me on X at Cameron May CS. And you can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion of using options to hedge or reduce the risk on existing positions. And of course, as we do, since risk is the topic, we need to bear this important risk-related information in mind. First of all, options carry a high level of risk and are not suitable for all investors. This material is intended for general informational and educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right. So with that important stuff accomplished, let's set an agenda for today's discussion. I want to take a quick look at what's going on in the markets and why, for some investors, for some traders, risk management might be top of mind. I think this might be a very topical conversation to be having. So we'll take a quick look at the S&P 500. We'll also take a quick look at an example stock, and we'll talk about how options might be used to reduce the risk exposure on an existing stock position when a trader or an investor has a suspicion that the stock might be about to go through a rough patch. And before we're done, we're actually going to be planning and placing a hedge trade on an existing stock position. So let's go right to the thinkorswim desktop trading software platform. This is the paperMoney version. You'll notice up here it says simulated trading. And let's look what's going on with the S&P 500. I don't think this is, again, going to be a huge surprise to anybody. We're in a very similar situation to where we were last Tuesday, where the S&P has rallied sharply off those March 30 lows. We've come up to a recent peak, up 13.7%. That was in just 18 trading sessions, so less than a month. Strong recovery from this about 10% sell-off from previous all-time highs. And here we find ourselves right up near those all-time highs. But if you'll notice, if I zoom in here a little bit, after this strong recovery, boy, you look at the last 1, 2, 3, 4, 5, 6, 7, 8 days, we haven't accomplished much. We had this great run, and now things are kind of moving sideways. And let's suppose that we have our hypothetical trader or investor here who has purchased shares of stock, and now they're thinking the markets might be getting a little bit top heavy. And their concern is maybe less about the potential for growth than it is for the potential for risk in the near term. And when something goes up this rapidly, what might it do next? Could it come down just as fast? Now, I don't want to be sounding like I'm sounding an alarm. That's not the purpose here. We're just laying a hypothetical foundation for a discussion of risk management. And then we're going to talk about, of course, how options might be used to accomplish that objective, hopefully to assist with it. Anyway, so that's the backdrop for what's happening with the markets. Now let's go have a look at a stock and kind of put ourselves in a more exaggerated role of a stock shareholder. So I'm going to go over here to Google. Let's say that we're shareholders of Alphabet. Let's put ourselves in the shoes of maybe an investor or a trader who purchased the shares. I just picked kind of a random price of 304.84. So let's just say we bought as the stock was chopping around. We thought it was at a price floor and didn't really get a lot of performance in the near term. You'll notice anyone having purchased back in these days has seen some significant volatility. Chopping around for a while, we're solidly underwater, but there's the stock market blasting off, and Alphabet got to participate in that to the tune of more than twice as fast of a recovery. If you look at this, up 29% as the S&P rose 13.7%. So for an Alphabet shareholder, that's a great run, but now they find themselves not only touching all-time highs, but also matching previous all-time highs. Maybe there's a price ceiling there that our investor is now really concerned about. So here we have our 100 shares of Alphabet sitting in our portfolio, purchased at 304.84, worth about $350, but struggling. That's the concept. Who knows if it's going to struggle from here? But right at about that $350 previous price ceiling, you can see that yesterday there was an attempt to rally up and through, and we faded. Today it looks like we've had a second attempt to rally up and through, and we faded again. And let's say that our concern now is protection of profits or the management of risk. Now, as shareholders, what could we do if we are really convinced the stock is just about to plummet? Could just sell the shares, right? And especially as we look right over the immediate horizon, today is April 28th, tomorrow's the 29th, and after market close, Alphabet's going to announce their earnings. And a stock that has rallied 29% in just 18 days, what could a poorly received earnings announcement do? Could that spark us to a sharp run to the downside? Yeah. So let's just say that our trader here highly concerned about risk. And so their priority right now is protection. How might options be used to protect an existing position? Well, we've already discussed we could just sell the shares. Then there's no risk. There's also, though, no reward potential. So instead of selling the shares, maybe what our trader here will do is get into a contract that gives them the right to sell the shares if they decide to later, just not right now. So that's what we're going to be doing. First of all, we're going to go through strategy number one. This is hedging strategy number one, which is known as a protective put. So let's just say that our trader wants protection. Since this was an 18-day run up, maybe we're looking at protecting for the next 18 days or so. Well, that would actually take us out to about the 15th of May, kind of conveniently. That's the next third Friday expiration for an options expiration cycle. That would also get us through this earnings announcement. So here's what we're going to do. Yep, CBA 82 says let's go buy a put. It's exactly what we're going to do. Let's go to our trade tab. Let's look at the 15th of May, and we're going to move our attention over here to the right side of the option chain, which is where the put options are displayed. And with the stock trading, around 350, what if we were to do this? Let me eyeball the option chain here for just a moment. Just let me see how I want to discuss this. Yep, this is what we're going to do. All right. Let's say that we buy the 345 put. So here's our hedge let's make it bold. I always prefer bold. So we have hedge strategy number one, which is a protective put. So in this case, we're going to buy the 15th of May 245 put, and that looks like that's trading for around $9.95 to $10.35. Let's split the differences. Let's say that it costs us $10.15 per share. So first of all, what are we trying to do with this? Well, if we were to buy that put, we're now entering into a contract which doesn't require that we sell the shares right now. But if the shares collapse, we have the contractual right to sell the shares to someone else. And in this case, it would give us the right to sell the shares for $245. So there's a little bit of downside risk. If we're trading at $349 right now, and I said 245, let's put in the correct number, 345. But this will give us the right to sell our shares, to put our shares through a forced sale into someone else's portfolio, if we choose to, for $345 per share. A little bit. Notice that would take a little bit off the top of the profits that we have right now. We'd be surrendering a little bit. There's still a little bit of risk to the downside. But for that right, it's not like somebody's doing this out of the kindness of their hearts, where they're just saying, "Sure, Cameron, I'll buy your shares. I'll pay you $345 anytime in the next," look at this, it's 17 days. We had 18 days up. If the old saying that says that stocks climb stairs and fall out windows, if that proves accurate in this case, maybe the 18 days up, could we drop in just the next few days, the next 10 days? That's a possibility. So 17 days might get us through that choppy period that we're concerned about. Maybe the earnings goes well and we pop up through that resistance, or maybe we're more definitively seeing what the stock is going to do, within the 17-day window here. But in any case, the other trader here is not just saying, "Cameron, I'll take your shares off your hands for $345 per share." We're actually paying them a per share incentive to do that. That's what this premium is for. We're paying theoretically $10.15 to motivate someone else to sign on the dotted line, so to speak, to agree to buy our shares for $345 at any time in the next 17 days, entirely at our discretion. All right? That's what this contract is. Gives us the right to sell our shares if those shares collapse in value. Eric says, based on delta and liquidity, isn't 340 a better deal? Good question, Eric. And I have to say this, okay. Ranking options on a qualitative scale, extremely difficult, because underpinning these options prices is something known as the Black-Scholes formula. It's the way that the options prices are calculated, and it is so precise, it actually won a Nobel Prize for its, well, it was authored by two people, one of them died, so it won a Nobel Prize for the one surviving author because of its precision. And if we think that we can spot, ooh, this one is overpriced and that one is underpriced, I need to go yank that Nobel Prize back from the owner because they didn't earn it. No, options are very keenly priced, very accurately priced according to the variables that go into current and future values of options. So better? If you were to twist my arm, I would say, no, it's probably not better. It's probably not worse. It's probably accurately priced for what it's offering. Now, that doesn't mean that a trader might not choose a different strike price. I've just chosen this one as an example because it's relatively close to the current price. That was number one. Number two is, if we're willing to give away a little bit of wiggle room on the stock, it does reduce the price of the option. Now, here's the thing about protection on options. More protection is more expensive. So what degree of protection are we getting, to go to Eric's point about delta? What is delta? Well, let's add the Greeks to our columns here. So I'm going to go up here right now I have field price and mark selected. Let's choose the Greeks. So we have delta, gamma, theta, and vega. And if we go to the 345 strike, you'll notice it has a delta of minus 43. Now, delta starts with D, so does dollar. The way that I think about this, there are a couple of different applications for delta. Number one, delta gives us an approximate likelihood that the option hits expiration with at least 1 penny of value. So that's one use of delta. Another, though, is a gauge of how much that option might make or lose as the stock rises or falls $1 right now. So delta starts with D, so does dollar. You'll notice it's a negative number because the assumption of delta is always that the stock goes up $1. So if the stock goes up $1, How does our put do? It loses 43, now 42 cents. It is a variable number. You'll see as the markets are open, you'll see it change a little bit. But yeah, right now it's hovering right about 43. How about we just put this in here just for reference? So as it changes, we have it static. Our delta is minus 43, right? Because it assumes the stock goes up. Well, we're assuming the stock goes down. So if the stock goes down $1, we don't lose 43 cents on our put investment. We make 43 cents on our put investment. And that can help us take out some of the pain of the trade initially. So that's one thing that can give us some insight into how much risk coverage we're getting here. We're getting about 43 cents on the dollar in initial risk reduction. Does that make sense? Now, another thing that we need to do is just acknowledge the fact that regardless of delta, at any time for the next 17 days, we have the right to sell shares for $3.45. So if they fully collapse, if the stock drops to 300 bucks a share, now I know that sounded like an exaggeration, but less than a month ago, this was a $272 stock. Let's say the next 17 days goes proportionally poorly to how well the previous 18 days went. Let's say that we drop back down to 272 bucks. Now, hey, regardless of the delta, we know we have the contractual right to sell shares for $3.45, and that's where this protection can really kick in. The stock has just gotten whacked to the tune of, let's do some quick math here, $348, all the way down to 272 is what is that? That's about, is that 66 bucks to the downside? $76 to the downside. Yeah, that would be a $76 collapse in price, but we still get to sell it up here for $3.45. So we took a $4 haircut against a $76 loss, except it did cost us 10 bucks to set this deal up. So instead of losing $4, we might have lost 14, including the cost of the put. But boy, did that give significant protection in that very hypothetical scenario. So that's why it's known as a protective put. It offers initial protection if we just want to sell the put to offset some of the drop in share value. It also offers extensive protection in the case of a severe drop in price and we choose to exercise our put and actually sell the shares. It allows us to sell at a fixed price. Eva says there's a survey. Thank you, Eva. Yeah, there is a survey. These don't happen all the time. So let me just make a quick note here. If you're here in our live stream audience, there's a survey in the chat window. It gives you the opportunity to give me some feedback. And if you've never filled one of these surveys out before, they're really short. They're just 2 questions, and then there's a comments box and a suggestion box. And they're just 2 multiple choice questions, by the way. So you can just quickly answer those 2 questions, give any comments or suggestions that you like. What I will say is that if you take the time to fill out that survey, I take the time to read through that. I read through the data, I read through the comments. It definitely helps. It doesn't just disappear into the ether and the people who don't, or the people who should see the survey feedback never see it. No, it goes right to us. So it definitely helps. Thanks. And thanks for pointing that out, Eva. So what do we think about this protection? We have an earnings announcement. How could this earnings go? Well, if it goes really poorly, and let's just do this. Let's put in a trend line. If that earnings goes terribly and the stock collapses, well, at least we know that we have the right to sell shares for $3.45. If it's helpful, let me draw in a line right about $3.45. For that stretch of time, we have the right to sell shares for that price. So there's the degree of protection being offered, and the further the stock falls, the greater that protection becomes. Lawrence says, yeah, thank you, Lawrence. I really appreciate that. You say I'm terrific. That's always nice. Appreciate the style and my knowledge. Okay, excellent. I always try to go at a pace that everybody can follow. If I ever miss anything, though, that's why the chat is there. You can help me fill in the gaps in what I'm delivering. Just ask questions, and I'll try to get those addressed. And if I can't, Kevin's there also to help us out. But this is if the protection turns out to be needed. And sometimes, by the way, sometimes people, I think this is an unfair, it's an inaccurate analogy. I see the similarities, but some people say, oh, this is like insurance. No, it's not like insurance because like if you buy fire insurance on your home, what we're doing is we're getting protection against a highly unlikely event. So we pay a very small premium because the house probably isn't going to burn down next month. Matter of fact, over the course of a lifetime, the house is probably not going to burn down. It's something that just doesn't happen very often. On the other hand, when buying protected puts, what we're trying to do is protect against an event that actually happens very frequently, happens all the time in the stock market. How often does a stock drop in value significantly? Right here on Alphabet, this is one of the strongest stocks of the year, and yet it's definitely had times when it has dropped hard over the course of a 17-day period. And that might be particularly true after strong increases in price. As the stock price rallies up sharply, for some, they see that as a dialing up of risk exposure. And so after a strong run up it's a common time when some traders decide, I might need some protection here. Now, there are times, though, when it turns out we didn't need the protection. Let's drag this right margin down a little bit. Let's say that we thought maybe we're going to bump our heads and pull back, but Alphabet just continues to rally. Well, this is what the shareholder who sold their shares is worried about. Sold my shares and it keeps rocketing up. I'm not participating in that at all. When we buy a protected put, if the stock continues to rally, we're still participating in that. However, we have applied a little bit of drag. We've invested in a bearish derivative position. We've invested in a bearish option that is losing value as the stock goes up, and it can lose all of its value. So it's quite possible if the stock rallies sharply enough, we could lose the full $10 or whatever we spent on this put. Turns out we didn't need it. It's kind of like the premium that we paid and the house didn't burn down. All right, that's just a sunk cost. Or we might choose to just sell the option a little bit later before expiration, before it's lost all of its value. Just try to retrieve some value from that. But yeah, so if the stock were to rally sharply, let's say it goes up to 390 bucks. It's at 350. Let's say it goes up $40 to 390. Is that possible? Sure it is. Look what it's done over the last 18 days. So if it goes to 390, great. We've made an additional 40 bucks on our shares, but we spent $10 on protection it turns out we didn't need. So that actually applied about a 25% drag to that hypothetical scenario. All right, so there are pros and cons to buying protected puts. And what some traders will do is they look at this and they say, well, I do like the idea of protection, but boy, that's at 10 bucks a share on 100 shares, that's $1,000 just for 17 days worth of protection. Ooh, that seems like it's a little bit pricey. Gosh, it's kind of getting hot in here, right? I wish, oh, also they might look at this and say, and initially I'm only getting 43 cents on the dollar protection. I wish there was some way I could dial up the amount of protection I'm getting and dial down the cost of the protection received. Actually, that can be done. And that's by doing hedge strategy number 2. Let's do this. Let me grab this. I'm going to copy this. Let's paste it down here. Hedge strategy number 2 is known as a collar. All right. And it actually starts maybe with the same purchase here. All right. MSRI says, is that a way to know? Is there another way to know the range where it's cheap to buy an option? Know if the price to buy is too expensive? Good question. But again, that's assigning again a qualitative assessment on the price that we're paying on an option right now. It's like the question that said, well, is the 340 strike better than the 345? Qualitative. Is one cheaper and one more expensive? What I will say is that the options are priced very with a ton of precision. So the the amount of protection offered goes up proportionally with the price paid, basically, thanks to the Black-Scholes model. So trying to poke holes and saying, well, this one looks like it's cheaper and that one looks like it's more expensive, we can make absolute observations about that. So for example, if I go to the 340 strike, it is a less expensive contract, but that's for a reason. It's also less likely to deliver value for that investor. It also comes at a lower degree of protection initially, and if the contract is ultimately assigned. If I go to a higher strike price, it's allowing me to sell the shares at a higher price, and it's delivering a higher degree of initial and ultimate protection. But the cost is greater. There's not a mistake anywhere in the pricing of any of those. I think some people, what we want to do is maybe expend some intellectually energy trying to spot the errors in the prices. Oh, this one's temporarily underpriced or overpriced. Theoretically, that does not happen according to the Black-Scholes formula. All right. Charles says, is a protected put the same as a married put? Yes, Charles. No difference. It's just that with a married put, typically what the trader does is they buy the stock and the put at the same time. Maybe don't layer into it like what we're doing here with Google. But yeah, you can use those terms interchangeably. All right, but let's look at hedge strategy number 2. And what the trader here is attempting to do is twofold. Number one, trying to reduce the net cost of the protection being achieved. Also, dial up the degree of protection. And so what we do here is at the same time we buy a put, which is a bearish position. That's why a bearish position can help to offset the bearish exposure of a bullish position. Like if we own a stock and we think it's going to go down, that's the risk. If we own something that benefits from going down, that helps to offset that risk. So we already have a bearish position. What we're going to do is put on a second bearish position. You might say, oh, Cameron, well, that's just going to cost twice as much. No, actually, we're going to do a different bearish position. Let's look at, so if we bought this put for $10.15 and it has a delta of 43, let's at the same time, we're going to sell the 15th of May. How about we choose a contract that's about the same price? So somewhere around $10. Let's look at, it looks like the 355. We're going to sell the 15th of May 355 call, and that looks like that might bring in, look at this, about $10.15, give or take a few pennies. So what we're doing here is spending $10.15 to buy a put. That's a bearish trade. And then we're collecting $10.15 to sell a call. That's a second bearish trade. What's the net cost between these two? Spent $10.15, collected $10.15. Leave the commissions out for just a moment. Yes, there are commissions, 65 cents per contract. Net cost is, in this case, right at zero. Sometimes it might be a little bit of a debit. There might be a net cost. It might actually produce a little bit of a credit. But this is what's known as a collar. And what it does is it kind of collars the current, that's the term. It kind of puts our hands around how much the stock can lose, but also how much it can make. So here's what it actually does. We're in 2 contracts now. One contract gives us the right to sell shares for $3.45 if we choose to, but the other one carries an obligation to sell shares for $3.55 if someone else decides to make us. That's the deal on this call. So the trade-off is it collects a premium for us, and that can partially or entirely pay for the put that we purchased for protection. But the real cost here of this call is that it limits the upside of the stock temporarily as well as the downside. This is a strategy or a trade that a trader would probably put on when they're really convinced that the stock is likely to pull back, but they don't necessarily want to sell it. What they'd prefer to do is just get 2 bearish trades going. So if the stock does go down, the combined returns on those two trades are likely to make up for some or all of the loss on the stock position. Let's examine that. Probably going to be some, probably not all, but pretty close. Let's look at the 355 call. What's its delta? It has a delta of 45. Let's put that in here. Delta is, it's a positive, it's a plus 45. So let's do some quick math here. Let's say we buy the 345 put, sell the 355 call, not any real cost for doing that. And then the stock drops $1. Well, if the stock drops $1, that's good for our put, right? That would be a 43-cent unrealized gain on the put. But at the same time, this call, actually, we sold it. It's not positive. It's negative. That a call is assuming, again, the stock goes up. So it has a positive 45 delta if the stock goes down. If it goes up. If the stock goes down, it actually has a negative delta. So that would be adding 45 cents of unrealized gain to the 43 cents here. Both of these adding up to about 86 cents on the dollar of initial protection. Charles says, how did you determine the 355 strike? Is it to offset the premium? Precisely, Charles. Yep. Yeah, with caller traders, what they'll commonly do is they choose the put for the strike price where they would like their protection to kick in, 345 in this case. And then they'll look at a call that can maybe compensate for the bulk of that cost or maybe all of it. So that's what I did here. Our protection was costing us about $10.15. So I looked for a call that could maybe deliver $10.15 in premium. And that's what we wound up with. Now, it's probably not going to work out to be like a perfect offset. It might wind up costing us 10 or 15 cents, 20 cents net. It might actually generate a credit, 10, 15, 20 cents. So a nominal amount actually exchanging hands here, theoretically. But the degree of protection is substantial. It's effectively doubled because we have two bearish trades to offset bearish risk exposure on the stock. So this is known as a collar again, because if you think about, when you collar something, it's kind of an old, do you ever hear back in the old days, in the old movies, you'd say the police collared the perpetrator, they got their hands on them. It's like they grabbed them by the collar and got them under control. Well, in this case, what we're doing is getting our hands around the risk, but also the reward potential of the stock. Because if the stock falls, we have a put that allows us to sell those shares at 345. It's limited the risk exposure to the downside. But if the stock rallies, well, someone else has the right to buy our shares for 355. So we have a cap on gains, a cap on losses, theoretically. Yep. Now, E. Dunny says, if you were sure the stock would be bullish, would you do just the opposite, collar, selling a put and buying a call? We could, actually. That's known as a synthetic stock position. Yep. Really, that would be effectively, it would be very close to just buying more shares of stock in the way that it behaves. So, yeah, that's the short answer. I'm not going to go deeply into that. Charles says, can you place the collar at trade as an example? Yeah, I can do that, Charles. I think what we're going to do today is just buy the protected put ultimately, but how do we place the trade? Well, if we have multiple contracts at different strike prices, here's a quick way to get that trade entered. So within the account where we already own the shares, so here's our account. So we're in the right account. There's the 100 shares. We just go, we don't have to call it. We don't have to refer to it as a collar or anything like that. What we do instead is just go to the option that we intend to buy and click on the ask price. That creates the buy order down here. Now we just have 100 shares, so we only have to do one contract here. Now at the same time, let me just minimize that order. I'm going to go up to the strike price that we intend to sell, and I'm going to go over to the bid price. Now here's the deal. I'm going to hold down the control key on my keyboard and then click on the bid price. It's just a normal left click. But as I hold down the control key, you can see I'm doing that because you see how as I hold it down, you'll see some hotkeys appear on the screen. 1, 2, 3, 4, 5, 6, 7, 8. That's just your visual cue that I'm holding down my control key. But I'm going to click on the bid price, and that adds an order to sell calls, or sell a call in this case, to the order to buy a put. So there's our caller. Now notice this is just calling this a custom. That's okay. We don't have to refer to it as a caller. Let me make sure I got the right one. Oh, I know what's going on. There we go. I'd changed the quantity, but I hadn't yet clicked away from that. But you'll notice in this case, might be generating a small credit. It looks like that call actually may have gone up a little bit in price. The put's probably gone down a little bit in price. That's probably because the stock has gone up a bit. That increases call prices. It decreases put prices. So yeah, we might be looking at a little bit of a credit here on this trade. Now, that's neither good nor bad. We still have the same right and the same obligation. But this is our caller trade. Now, it looks like there's no cost to this trade, right? Or maybe even a small credit. Awesome. What's the real cost? Think about this. If it's not money coming out of our pocket, because it's really not, where's the real cost of this trade? There has to be a cost. Protection doesn't come free. What's the cost? The cost is we're getting downside protection at the expense of limited upside reward potential. That's the real trade-off. That's the sort of hidden cost that when you think about it, it's obvious enough. We know that if the shares go above 355, someone else has the right to buy those shares. If it goes to 360, 370, 390, 500, whatever, we have the obligation to sell the shares at 355 as long as this position is in there. All right, but I'm just going to do a protective put. Now, I want to, as I go to place this trade, I do want to give you a heads up on a couple of things. A lot of you don't know a lot about protective puts or callers, and some of you missed episode 1 and episode 2 in this 3-part series. So let's talk about that first. So it's a 3-part series about why traders trade options. So let me go to the Trader Talks Schwab Coaching webcast page on YouTube. If you haven't subscribed to our YouTube channel, make sure you do that. Pop down below the video, click on the subscribe button. It only takes a second to do that. It doesn't cost anything to do that. But this is where you can join our live streams, but also find playlists of previous webcasts and do keyword searches. And the keyword search that I would suggest you do today is 3 reasons, because we're talking about the 3rd reason. So if we type in 3 reasons, there's episode 1 and episode 2. The 3 reasons traders trade options, episode 1. The 3 reasons traders trade options, episode 2. And then what I might also suggest is if you're interested in learning more about protective puts or more about callers, you can search for those kinds of things. Let's just type in, you could even stop probably with protective, that'd probably work, but let's be a little bit more specific. Look at this, protected puts using options to hedge a stock trade. This was a full 44-minute presentation dedicated just to that strategy. And if we go to, let's say, callers, we have all kinds of webcasts on callers. There's James talking about callers. There's Brent talking about callers. So make sure that you, if you have an interest in a specific topic and you don't feel like the coach covered all the bases that you'd like to have covered, you can go there. But let's go buy a protective put. So let's just do it right from scratch. We own 100 shares. Let's say that we're just going to buy the 345 put. I'm going to go right to the ask price for the strike that we've selected and click on that ask price and make sure that the quantity, each contract is for 100 shares. So we don't need 1,000 shares protected. We're just looking for 100. So we're going to change that quantity to 1. It looks like our price, we might still be able to get that. Oh, look at that. If we offer to do 10.15, that's actually a little bit above the current price. I'm going to put in a limit order at 10.15 saying I'm willing to pay up to that much, not more. It's very likely we pay less because that's where the market looks like it's settling at the moment. But we're going to be willing to spend up to $10.15. Let's click confirm and send. I'm going to buy just one alphabet, 15th of May, 345 put for $10.15. I'm doing it within the same account where the 100 shares are held, so I don't have to designate it to cover the other shares. That's done automatically. There is a commission on this trade of 65 cents, so that could bring the total cost up to just over $1,015, and throw in the 65 cents. But let's send this order off and see if we can get a quick fill on our protective put. Let's go to our monitor tab. I can see our working order. We're offering to pay 10.15. It's trading around 10.02. Yeah, I was going to say, I think that's going to fill pretty quickly and probably lower than 10.15. Looks like we got our protection for $9.95 per share. So we know earnings are tomorrow, but through the 15th of May, we now have the contractual right to sell shares for not a penny less than $3.45. For that, we pay $9.95. So, guys, we've accomplished what we set out to do today. I hope that this has been an interesting discussion for you. We've just rounded out the third installment in our three-part series of three reasons why traders trade options. So we've gone through speculation, income, and hedging. So this is what we do with our Tuesdays. We talk about getting started with option strategies. And sometimes I like to just strip it down to the basics, like what are the motivations for doing this? So thanks for following along today, guys. Make sure that you've subscribed to the channel, just like I've shown you. Also, Kevin and I would definitely suggest that you follow us on social media. If you're wondering how to connect with your favorite presenters when the camera's not on, it's done through social media. So you can find and follow Kevin and me on X. You can find Kevin on X at Kevin Horner CS. You can find and follow me on X at Cameron May CS is my handle. And if you reply to one of my posts here on X, I just try to reply right back to you. And I do the same thing on LinkedIn. So you can go over here to LinkedIn. Nice thing about LinkedIn is it doesn't have the character limit, so you'll see frequently longer posts on my LinkedIn account. And if you reply to one of those posts, I just try to reply right back to you. Again, it allows for interaction when it's not otherwise available except for during the live stream webcast. All right, everybody. Thanks for giving me your time. Kevin, thanks for helping out in chat. I'll throw out one more quick reminder. There is a survey, so if you would just fill out that survey, it's only two multiple choice questions, and then a comments box and a suggestion box. I'll tell you, if you take the time to fill that out, I always take the time to read through that data. I read through the comments. It's always helpful. Also want to thank you all for the thumbs up. There are 168 people still watching the live stream right now, and as I refresh the browser, I can see that 61 have already clicked that thumbs up. That is very much appreciated. Not only that, it's important. Yes, it's a nice pat on the back to your presenter. That's definitely appreciated. It's like applause. But it also gives my videos a nice little boost in the YouTube algorithm, helps more people find these webcasts and learn things like hedging strategies. So thanks for doing that. Everybody go enjoy the rest of our webcast for the rest of the day. We have several still on the docket for the day. I will look for you in tomorrow's webcast or in some other webcast between now and Tuesday, or maybe I'll just see you again next Tuesday. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.